Well, without, I think, no more technical difficulties, we'll be able to get started. We have two lovely presentations we're going to have before Q&A today on cryptocurrency. The first is going to be given by Mary Pieterse-Bloem, professor of financial markets, and this is going to be specifically on investing in crypto. Is it wise or speculation? Thank you so much.
Okay. Well, welcome everyone. It's a very current topic, this crypto assets. Actually, so the title of my presentation is Investing in Cryptos, Wise or Speculation? I'm indeed a professor of financial markets, professor of practice, as they say. So that's 1 day a week. My other time I spend at Rabobank. And it was actually with my colleagues at Rabobank that we did a white paper on cryptos. I must say that I prefer not to speak about assets that we do not have in the portfolio, because as CIO, I am responsible for the financial and sustainable returns of the money that our clients want to have invested, and in the discretionary portfolios, we are actually essentially investing this money for them. So it's down to us how in which type of asset classes we are investing this money, and cryptos is not in our mix, and I prefer not to speak about things that I do not have in the portfolio, because if I would do that, I can spend my time until Christmas this year talking about real estate, infrastructure, gold, cryptos, and what have you not. But my hand was forced because at Rabobank we did a little research together with Nibud. Nibud is a not-for-profit organization that does, that does inquiries into what people, financial wealth and financial health of individuals, and it turned out that crypto played a big part with young investors. So before I start, can I ask you, who has their money invested in cryptos? Okay, about half, including the wise professor here.
But I bought in 2013. So.
Well, you did well. So let's see. Is it wise or what should we really be? How should we really be looking at cryptos? Well, of course, Bitcoin is the most famous, and was probably also, I think, one of the first, if not the first, crypto assets. In the meantime, there are many. So how can you kind of cut across or create some kind of an overview of what crypto assets are? Well, the definition is that it's a digital asset that uses cryptography and distributed ledger technology, of which Bitcoin is just one example. There is currently no single taxonomy, but the following dimensions here on this slide will help you to develop a view of the different types of crypto assets. So the dimensions are the technical layer, the purpose, the underlying value, the utility, and the legal status. So with technical layer, you can think of the fact that there's primarily a distinction between native and non-native tokens. Tokens on their own native blockchain are often referred to as cryptocurrency, while digital coins built on another existing blockchain are non-native and are referred to as tokens. In addition, there are tokens that are used within a decentralized app. So one often distinguishes between these three types of technical layers on which the token or the crypto assets is being implement it? The purpose? What is the intended purpose of the token or cryptocurrency? A token can be considered as an alternative currency, so a form of money to only make payments with, very important, so medium of exchange, but that is not always the case. Often the intended purpose is to gain access to a certain network, but it can also be a way to invest in something or gain exposure to a certain asset. Yeah? The underlying value, what's the underlying value of the token or the cryptocurrencies? Some do have an underlying value, so tokenized gold, for instance, has got that, but others don't. Well, and you can see also with utility, what is the usage tokens or other types of tokens, and then what is the legal status. Now, if you look at, you can plot all the different types of cryptocurrencies into this space. So here, Bitcoin, you can see where in the different buckets it would fall. And this one is Ethereum, I believe. Yeah. So that's how you can basically make a bit of and that's Tether. So that's how you can make a bit of a distinction. What is nowadays the market share of the top 10 cryptocurrencies? Well, the global crypto market is $1.9 trillion, according to coinmarket.cap, with Bitcoin representing about 40% in the yellow space of this value, Ethereum accounting for about 20%, and the remaining altcoins accounting for 40%. The market for crypto assets is therefore very concentrated, despite the fact that there are now more than 17,000 crypto assets, of which more than 9,000 are traded on an exchange. Bitcoin is still dominant and is still seen as the most important cryptocurrency. The interest in crypto funds, so these are mutual funds, if you like, or ETFs, that you can buy on an exchange or via kind of like an investment account or whatever, or via an app that are built on these crypto assets, has grown very substantially. So in dark blue it is the total of crypto funds, and then in orange the ones that are built on Bitcoin specifically, and then in light blue the ones that are built in on Ethereum specifically. This is the research that we did last year, from about in about the third quarter of 2021. It was announced in November, and when I saw the report, and the report was something like 20 pages, and it the research was on what do young people do, youngsters do with their financial wealth. There was this one element in there: 27% of people invest or have some of their money in cryptos. I immediately said, this is what is going to be picked up in the media. And I was right, because it caused a storm of media interest, just this little bit of, just that fact in that whole report, okay? Now, but I think the report was interesting for other reasons as well. Relatively many young adults invest, okay? So, and investing, that, so they have savings, but they invest. So the interest in investing has grown, which is something that I was very pleased with. So as many as 31% of the young adults between the ages of 18 and 30 have one or more of the traditional form of investments, such as stocks, bonds, funds, or index trackers. And of this group of traditional investors, about half of them own cryptocurrencies as well, because there's some duplication in here as well. Out of those that hold cryptocurrency, it's only 10% that only hold cryptocurrency. So they also then hold some kind of traditional form of investments as well. But if you drill, down into the detail of this report, then you will further find that it's rather striking that the traditional investors are more likely to have some money left as a form of a buffer, and they incur less debt than the other types of investors. So traditional investors are in a little bit of a better shape than the pure crypto investors, which is interesting because, as we will come to see in a moment, cryptos are a lot more volatile in terms of their price behavior, and it's actually therefore a much more risky way.
Mary, so this role can make ends meet. That worries me a bit if only 18% of the traditional investors. How's that?
Yeah. Well, these are still very young people, huh? They have very, very little income or are perhaps still studying.
Okay.
These are people between 18 and 30.
Okay.
There are some so that's actually
Otherwise, you should be worried.
We should be worried if this would apply to the total population in the Netherlands, but it doesn't. It only applies to the very young people. In that sample, opinions also differ between traditional and crypto investors. For example, on the first statement, investing in stocks, bonds, funds, or index trackers, so the traditional way of investing is a good way to build up your financial wealth. Okay, so the traditional investors, 68% agree. Cryptos slightly lower. They don't necessarily disagree as well, but they're a bit more neutral on this statement as well. But if you look at investing in cryptocurrencies is a good way to build your wealth, then far fewer traditional investors agree, and actually quite a few also disagree, but the crypto investors seem to agree and few of them disagree. So they look at this type of where they put their money in cryptos as a good way for building up your financial wealth. And then a fun fact here as well is that we also tested whether people were financially well educated or not by asking a certain question and to see what reply they would give. And the question we asked them, is it true or false that a stock of a single company normally gives a more certain return than an equity fund? What is that? Is that a true or a false statement, according to what we learn here in the lecture rules? Who would say that's true? Who would say that's false? It's false. Okay. So if you would have answered true, then that would not have been the correct answer. Okay. So the traditional only, 58% got it right by saying that's a false statement. Crypto only, 34% got that right. So the people that are investing in cryptos only slightly have less knowledge on average, according to this one data point, we must say, on the way finance tends to work. Then, we at Rabobank, we dived into the question, how does crypto stack up to the other more traditional form of asset classes? Okay, and so you can look at a number of categories, so stock, bonds, alternatives. Alternatives would be commodities, for instance, or gold, Then the traditional currencies, so euro, dollar, you know, and then the cryptocurrencies. And then you'd say, okay, for example, on what is the can you determine what would be the expected return? Can you relate that to anything? Well, with all of those categories, you can. With currencies, it already becomes a little bit more difficult, but it is probably the interest that is being received when you put your money into dollars, for example. But with crypto, it's very, very difficult to relate it to any kind of underlying fundamental driver in the economy. The volatility varies, okay, so for stocks and alternatives, it's high. You know, traditionally stocks, the annual volatility over a long period of time is something like 17%. For commodities, it's a little bit higher, even 20%. For bonds, it's low. Currencies, fairly average, but for cryptocurrencies, it's very extreme. Volatility is extremely high. Well, and then you can look at all sorts of other categories as well, but those are the two ones to remember. The Bitcoin price has been explosive, rather choppy of late, but also extremely volatile, specifically over the last couple of years, and that puts them on a risk volatility, on a risk return spectrum in a completely different league, okay? If you would only look at the traditional bond, the traditional asset classes, you know, the spectrum is typically related to something like 20% volatility max, 20-25% return max, okay? But if we have to plot where the cryptos are or have been, rather on a historical return volatility, and they're all the way out there. In this case, volatility coming up almost to 200%, but so have the returns. Looking at past behavior, looking at where they relate to in terms of, you know, so this is lots of risk for the so-called returns, and then in terms of their correlation, the correlation when market stress is low tends to be fairly low with other asset classes, but that's when the VIX is, you know, close to zero. But when the VIX goes up, the correlation rises. Right? So in times of stress, the correlation with stocks rises. There's not so much correlation with bonds, but actually, if you look to see where the biggest correlations are, then it's with gold and with tech stocks. So big tech stocks. And tech stocks, why tech stocks? Because tech stocks are the highest beta segment in the stock market. So they are related to the most volatile categories, the highest beta categories within the traditional asset classes. And as a matter of fact, particularly in times of stress, this volatility shoots up, and the IMF has also noticed, because they're now increasingly more concerned with financial stability, specifically because of this correlation. Okay, now, what did we do here? We did a bit of a back of the envelope type calculation. Is what role would cryptos play if we were to add this into our portfolio? Yeah. So let me see. If we were to add this into our type of portfolio, so the chart shows the optimal weights of the efficient frontier when we're using historical returns. The chart shows that cryptos have no allocation in a minimum volatility portfolio, the most left bar. We don't see any cryptos there. However, there's a positive and increasing allocation of cryptos for more risky portfolios. That's not so surprising, since the average annual historical returns of cryptos has been between 130 and 180%, while the returns on shares was only 13% and the return on bonds was 3%. Okay, but past returns are no guarantee for future returns, as we know. So we also need to look at the picture when we are using normal return expectations. So that is what we can expect in the future. And then you really must wonder if it's likely that returns on cryptos will be as high again in the coming years due to the increased market capitalization and increased competition. When we calculate with similar returns as what we expect for stocks, right? So we just put the future return of cryptos the same as stocks, the picture already starts to look different. If you calculate with an equity return of 6% and a bond return of something like 1%, then the result shows that crypto offer virtually no added value to a portfolio consisting of stocks and bonds if they're equated with stocks, because the volatility is simply too high. So the low Sharpe ratio is not compensated by low correlation. Logical, because if you start to calculate with the same kind of volatility that we've seen but much smaller returns, then they drop out of the portfolio. You can also turn the question the other way around and ask yourself, you know, how much return do you need for cryptos with the same volatility if it wants to have any kind of place of significance into a portfolio? And then you need a return of, well, a minimum of 10% going forward. And then you will have a small sliver of cryptos in your portfolio. And you need a return of 25% to make it, coming up to like 7 or 8%. So you see, what we're actually trying to say is that for all the volatility that we have seen, you need as an investor a significant amount of return or reward to validate a position or an investment into cryptos on a long horizon. And then, you know, you start to wonder where do the returns actually come from with cryptos? Because with a stock, it's obvious. You buy a certain amount of a company, the company generates economic activity, the economic activity is profitable, and as a holder of the assets in the company, you get a reward, which is dividend, and which is the growth of profits of that company until the company goes bust, and then you lose your money, obviously. With a bond, you also get a reward that is linked to fundamentals, because a bond promises you to pay the coupon payment, and the coupon payment is what companies can pay out of their profits or out of their cash positions, okay, which are the more healthier, the more the company grows, or it can be paid by a government because the country is doing well. Yeah. So, but it is awfully difficult to try to link the value of a crypto assets to fundamental value. And that's why we've said a Rabobank, you know, that's what separates a traditional asset class from a purely speculative asset class. And for the same reason, we do not hold commodities in our portfolio as well. So CFA agrees with us because they provide the following characteristics for properly defining asset classes. The investment within the same asset class show both qualitatively and statistical similarities. That is also difficult with cryptos because of the sheer amount of cryptos that we have, and they take on different characteristics, as I've shown you on the first slide. The different asset classes have low correlation between them. Investments can only belong in one asset class. The investment in different asset classes cover the majority of all possible investments. The asset classes have a high degree of liquidity and they can be linked to fundamental value. Okay, for us, investments must have that fundamental anchor. For both equities and bonds, there is, but for cryptos, that is very difficult to argue that. So what are cryptos then? Well, they are speculative. It's whatever price someone is willing to pay for it. Above all, they're not only speculative, they're also very risky because there are a number of risks attached. One prime risk is regulatory risk. The biggest risk when investing in crypto assets is the risk of unfavorable regulation. The most extreme example of this is a ban on owning and trading crypto, which is the case in India and China. There's no ban in Europe yet. It could come, you never know. Because there can be many reasons for putting a ban on cryptos. Widely used for illegal activity, such as money laundering, tax evasion, ransomware, and a means of payment on the dark web. In addition, authorities are concerned about the highly speculative nature of cryptos and the use of leverage when trading crypto assets. A major crash can also pose a risk to financial stability, as has been pointed out recently by the IMF, and a crypto ban in Europe or the US would have major consequences for investors. Okay, management risk when investing in digital assets. You may have to deal with the loss of private keys or scams. There was one in a newspaper recently where some bandits took, I think, fairly large amount from one of the crypto platforms, and then try to recover your money probably is going to be proved to be very difficult. There are a whole lot of other risks. The one other risk that I want to mention to you is monetary policy. Maybe Casper will speak about this as well, but monetary policy in the coming period and the question of whether we are slowly leaving the environment of negative interest rates behind us is also important, because to what extent is the demand for cryptos mainly driven by speculators who have been looking for a positive return because of the negative interest rate environment, and to what extent was that mainly because of the ease of payment of, for example, Bitcoin. We're not discarding Bitcoin's crypto assets completely, not at all. We think that the technology behind cryptos is very interesting, but in the very liquid market space that is not yet very investable, because you need to then invest in companies and buy the shares of companies that use that technology for their own business models. Okay, so that is interesting, and we think an interesting development as well are the central bank digital currencies, but I will not say much more about that because I have an inkling that maybe Casper may talk about that. Okay, that was my talk. So wise or not wise, make up your own mind, but at least do so in full view of the information. Thanks.
Thank you very much. And I'm sure everyone has some questions, but we'll do questions with both speakers after the next presentation. So next, I have the pleasure to invite Casper de Vries up. He is Professor of Monetary Economics and Professor of Finance, while being the chair of the Witteveen chair. Witteveen was
former director of the IMF and Minister of Finance in the Netherlands.
This will get better, hopefully. Who's going to now give a wonderful talk on Bitcoin and central bank and digital currencies, or CBDC.
Okay, thank you so much. Yes, indeed, I will take more of a public view of, so I will talk also about CBDC. So a bit of history of money. For a long time, even in biblical times or before biblical times, there was use made of precious metal as a way to pay each other. And of course, in the older time, there was a lot of barter. Inflation is shaving. What does that mean? For example, we had hyperinflation in Roman times, and what they did at that time was shave the coins, so shave a little bit off, and then if you do it on many coins, you can make a new coin. This is what the emperors did repeatedly in the Roman times, and that's why on all Dutch paintings you see where they try to weigh, whether the coin has the right weight. Anyways, and actually at the time around 1500, the Ripper and Kipper time, there were also about as many different type of coins as we have now in Bitcoins or cryptocurrencies. Every city had its own money, mint. Well, then there was this innovation in Venice around the 16th century because the traders, merchants of Venice, they had to cross the Alps, and then carrying a bag of gold is quite heavy. You could easily be robbed. So there was this innovation, the bill of trade. So a banker sitting on the square in Venice would sign a note, and then they could just take that to pay. And then eventually the note would come back, and he had to pay in gold. What these bankers noted that it could take a long time before this bill would come back, because somebody would pay with this bill, and then somebody else would accept it with a haircut, and so this is how it started to circulate. And so they realized that they would not have to keep the full amount of gold as a backing. But then sometimes these bills came back, or many came back at the same time, and they couldn't pay. And then these bankers, they were sitting really outside the square in Venice, and their bank would be taken up and smashed on the calling out Banco Rotto. So this is where the word bankruptcy comes from. Anyways, so that was the first innovation, really transition. What there was before precious metals, we do not know. But around 1500, things started to change. People started to accept paper money in exchange for goods. And then, of course, governments came along. They started to issue smaller bills, smaller bonds. For example, the Dutch had a hand in this when they started the Bank of England. The Dutch king was made king of England at some point, and they had a war, eternal war almost always with France. So they needed money, and they started to issue smaller bills to finance the war, and these bills started to circulate as money. And then, of course, commercial banks started to do that. We had before 1909 in the US, you had many different types of dollars. Each bank could issue their own dollars. Okay, and so and then slowly we shifted towards less backing by gold and more use of these bills. Around 1950 in the Netherlands, 50% of payments was still in cash. Also, I remember collecting my wage in kind, so to speak. But then commercial banks, they realized that it would be beneficial to them to actually try to hook people on paying electronically or initially by writing checks, because then the money would stay in the system and they could actually offer more credit. Okay, so I gave away actually this question. And so commercial banks like actually the current system. So in the 1950s, commercial banks in the Netherlands still had very little to do with the payment system. They basically were only financing firms. But nowadays, then they started to realize how important that they could increase their reserves or their base by actually keeping the money in the system. So if you, if for example, Mary gives me a loan as a Rabobanker, she just credits my account with Rabobank. Nothing changes in a way, only that the bookkeeping changes. So the Rabobank now has a claim on me, and I have a claim on the Rabobank because my deposit increases. And if I then pay you, who also has a bank account with Rabo, for the bank, nothing changes. So, and then, but if you would take out the money in cash, then the Rabobank has to hold the cash. Okay, so what banks started to realize in the 60s and the 70s, that by hooking people on this, using bank money, that they could actually issue much more credit. So this is actually, and this is different from another institution, credit institution, or well, properly not called credit institution, but like a pension fund. They first have to have the money ready to invest, but a commercial bank not. Okay, the only thing they have to make sure is that the credit they give has sort of value. So if you buy a house, you know, they assess the value of the house. But in a way, for a bank, it's much easier to give credit than for any other non-bank. And you can see this actually in this picture here. So the amount of bank loans and the amount of money actually almost go up 1 to 1. And that's because it's so easy for a bank to give credit. And for econometricians, the two series are co-integrated. Which is it. And so what we have almost not realized how it has changed, because I grew up in the 60s, how things changed from using cash to using bank money has transformed the economy, because now banks are so important in giving credit, where this was much less the case beforehand, because they had to hold the reserves, because you would take out cash. Okay. Okay, so this was a big transformation of the financial system, and for example, one can blame the credit crisis in 2008, 2009, partly on the explosion of this system. So the question is how to restrain banks, and this is where Mary will hate me. So there are several. It's also the tax system that favors debt financing over using your own equity because of tax deductibility of interest rates. But this is an important one. And so that's why I'm also interested in Bitcoin, or maybe we can get people hooked back on using alternatives to bank money, because this credit explosion, and this is sort of, if there's credit is good for an economy, but only to a certain extent. And so, for example, there's been a lot of research also by IMF that if a government borrows, this is okay, but if the net debt of a government starts to be around 100%, then this may actually backfire and slow down the growth of the economy. And many of our economies are now in this region. And the same is true for the private sector. Too much credit is dangerous, may trigger a financial crisis because people start to doubt the underlying value, and you get economies that behave much more volatile. Okay? So somehow restraining the banks is important, and then the question is, can Bitcoin do this? Well, then you have to ask yourself, and that's a bit where our slides overlap. Is Bitcoin money? Well, there are three very important properties of money. It must have wide acceptance, because if I started to talk in a different language, Russian or so, nobody, maybe one person might understand in this room, but it's ineffective. So actually, many people have compared money to language. If you all speak the same language, then it makes things easier. So there must be wide acceptance. I indeed started to invest in Bitcoin just a little bit because as a professor of monetary economics, I thought I have to know how it works. Well, it was a pain in the neck at the time because there was, you couldn't use your app at the time. There were no apps. So I had to spend 2 nights to get a little bit of Bitcoin. And I still have it, I must say. And I thought, this is never gonna work. If I spent 2 nights on getting Bitcoin. But nowadays, of course, it's much easier. And of course, this is why, many young people now try to dabble in this market. Okay, so wide acceptance. You must be able to pay everywhere. It must be trustworthy. That's another very important characteristic of money. And then there's this question of hacks, etc. So is Bitcoin trustworthy? And it must have stable value. Because now we have inflation of 12%. So we may start to doubt the value of the euro, but you want to have to be more or less certain of what your money can buy. And with Bitcoin, that is a big question. And Mary already talked about this. And then Mary asked, what is the underlying value of Bitcoin? And it might be purely speculative, indeed, because you think that another sucker will buy it and then you invest in it. But there is some underlying value. And that is, it's used, in drug trafficking and by failed states. So that is, if you invest in Bitcoin, you invest in the black market, basically. So you're speculating on the black market. If you had asked me this question, that would have been my answer. And the black market is big, so maybe it is used. It is understandable at least. And this is the same picture, not surprisingly, with a Bitcoin price over time. But here I took another comp and one. So Mary showed this picture of trade-off between volatility and expectation. Another way to do this is look at a company like Shell, and you plot the returns. The daily returns of Shell and Bitcoin. And actually, you have to be very careful with the axis. This is 0.25. 0.25 here is here. But, if I had compressed it even more, you would not have been able to see. So indeed, the scale is entirely different. And so the risk is bigger, is very big with all these cryptocurrencies. So perhaps Bitcoin is not money, and a public solution is more interesting. CBDC, central bank digital currency. And actually, I work 1 day a week for the government. The Dutch government has a very interesting institution. It's called the Scientific Council for the Government. And this is a special section actually of the, we are directly reside under the Prime Minister. And we give advice on long-term issues for the government. So they are not, they're basically not so very politically, so we can easily say what we want. We are independent, nobody can restrain us. We can choose what reports we write, on what topic, etc. So it's very interesting. 7 professors and we have 30 staff working for us. And so I chaired the report on money and debt. At the time, there was a lot of upheaval in the Netherlands due to the credit crisis. There was even a play, if you remember, some Dutch may remember this, Door de Bank genomen, which is maybe not proper to translate in English, but and so yeah, they basically displayed all these bankers that would grab your money and do bad things. And so there was a public request, could we look at this issue? And we said, yeah, that's in the interest of public. So we wrote a report on it. And in one of our advices was to seriously look into CBDC as a counterpower for banks over issuing credit. And initially there was a lot of counter, so at the Rabobank, yeah, he was not really, Wim was not really charmed by it. The Dutch central bank was fiercely opposed. And the argument was, you know, if you start to do that, then, and if people start to use indeed CBDC as money, then it will make it more difficult for banks to indeed give credit, but it might also trigger a bank run because people then could ask the money back from the bank and put it in the CBDC. We actually think this is, you know, if you know history, you go back to the 1950s and 1960s, this never happened, okay? It doesn't mean it cannot happen, but the bank has to, I mean, so the virtue of this is that the bank has to think much better about what credit to give, because they must make sure that the credit is actually has enough value and the collateral is. So of course, for an individual bank, this is a sort of not so nice story, but for society as a whole, I think it's much better if we have too much credit floating around in our societies. Anyways, so CBDC might be one way to actually put some constraints from the market instead of, you know, the Dutch central bank telling banks we cannot give that much credit, which is always a difficult thing to tell. But if the market tells you, it's much easier. So I'm maybe as much as a market person as you are, Mary, and so I believe in institutions in the market such that the market itself finds sort of the equilibrium rather than the government who cannot assess exactly where the equilibrium is. So we wrote this report, and then the Dutch central bank, actually under pressure by the finance ministry, said, okay, we'll look at it again, and they wrote actually a very favorable report on CBDC about 2-3 years ago. And then this was sent to the ECB, and then the ECB said, okay, we really have to look at this. And then came Libra, you know, this Facebook currency that would be the basket of different currencies. And they, you know, also the Fed and the ECB, they started to become worried because they might be sidelined, and monetary policy might be out, because if these commercial firms take over, and of course the commercial banks were also worried. So there's also market pressure now to see whether CBDC can be a useful thing. And there always, of course, there's never heaven on earth. By now you guys should know this. There's certain advantages. One is privacy. If you pay with Apple Pay, the commercial firms know what your interest is, and they use that information actually. But if you pay with CBDC, no, the information is only in a way with the government. So privacy is better guaranteed. That is, Francine Lagarde actually made that statement. One of my former PhD students, he wrote a paper that was accepted in a top journal exactly on this issue. Maarten van Oort, he's now at the Free University. And the second, I think, important advantage is that they put some constraints on banks, on commercial banks, because they have to think better whether they want to give this credit, yes or no. There's also some negative side to it. It actually makes it possible for the government to slam a negative interest rate on if everybody holds CBD, this electronic money. It's just pushing the push of one knob to take away a little bit of money from everybody. And actually, this happened before. In World War I, the French actually issued money that lost its value after 1 year. So this is, in a way, they try to do this. But the electronic version would make that much easier. So it's a worry. If you're in the Netherlands now, firms are worried that they cannot actually use cash anymore because banks are pressing on, also because of illegal trade. But in Germany, it's, you can still walk around with 10,000 euros, no surprise. If you pay a car cash in Germany, normal, also in Switzerland. But in the Netherlands and in Sweden, the cash payments are less than 5% nowadays. So things have changed. But the negative interest rate is a bit of a worry. But yeah, if you have a democratic government, that is maybe the best guarantee that those things would not happen. And you might be a bit worried about that then, although private firms cannot see what you do with your money, the government can see this, but maybe you want this actually because of all this illegal trade that is financed with Bitcoin. So there are two sides to it. So my conclusion is CBDC will come because, like around the 1500s, we didn't want to walk with gold anymore across the Alps. And now we have paper money and electronic money, or we have debit cards, and then very soon we will have a single card with CBDC. I guess, how long am I talking? 20 minutes now? So maybe there are some nerds in the room. I'll talk 2 minutes about tail index and equity index as an alternative for money. To supplement what Mary was talking about, the risk of loss. This is actually one of my specializations in research. You can show that actually, while in finance often people use the normal distribution, this is not what you see in reality. The normal distribution for risk management is the worst thing you can imagine, because the normal distribution has an exponential declining tail of the density, but in reality you see it by declining by power, meaning that there is much more probability mass in the tails. So the probability of a crisis is magnitudes higher than the normality. So for a risk manager, don't use normal, use the Pareto distribution. It's actually the distribution that's on top, C times x to the power minus alpha. So this is what we see in the data. The tail of almost all financial assets behave according to that tail and not normal. In the center, okay, but if you're a risk manager, you don't do that. So I measured actually on the graph that also Mary showed, from that I computed the returns, and I computed the tail index, this power alpha, and the same for Shell, and I also measured the scale. And you see that the scale is much lower on Shell, though it's speculative. And the tail index is higher, meaning that the tail declines faster. So also in that, along that dimension, the risk is much higher. And so what I've specialized in how do you calculate these tail indices? Yeah, well, this is the estimates. If I use just 5 observations or many more, you still get the same answer. So I totally agree with your graph where you show that the risk of Bitcoin is way out and much higher than even for one stock. And so I remember being actually in your phase of study, and we have a company in the Netherlands called Robeco that in the 1930s already started to make it possible for small investors to invest in a fund. And so I thought, why can we not use that as a means of payments? And then I found out as a student that DNB, the Dutch central bank, forbid, because I had an account, I opened an account there, I could not pay somebody else. You first had to transfer back into a bank account before you could pay somebody else. And they were worried about the same thing that now is going to happen. Okay, that's messed up.